And welcome to another edition of UFile's Let's Talk Tax, where we teach you how to be more efficient with your taxes. My name is Jerry Vitratos, National Tax Specialist with UFile, and today's topic is going to be 5 questions or considerations before choosing whether you will contribute to your RRSP or your TFSA. So this video is not going to be another typical comparative between an RRSP and a TFSA, where we see the technicals between each program. There are plenty of videos that you can choose from that will teach you the technical aspects of each one of the programs. What this video will do is break down your decision making into 5 easy questions. And depending on the answer to those questions, you can choose then the better course of action, whether to contribute to your RRSP or whether to contribute to your TFSA. Question number 1, how soon do you need the funds or the money? Do you need the funds within, let's say, the next 3 to 5 years? Or do you need the funds at a much later date, for example, over 10 years? If you need the funds in the short term, within the next 3 to 5 years, then hands down, the TFSA wins. And you're better off contributing that money that you have to your TFSA. Why is that? Simply put, because the withdrawals are tax-free when it comes to a TFSA, while an RRSP withdrawal is taxable when you withdraw. Now, unfortunately, you won't get the tax deduction with a TFSA contribution. However, you will also not be taxed when you withdraw the money. That's why the TFSA wins hands down if you need the funds in the short term. Now, it's true that an RRSP gives you a tax deduction when you make the contribution. So you might ask yourself, well, why not just put it in the RRSP, even if it's short term, in order to get the tax deduction? Well, remember that your withdrawals are taxable when it comes to an RRSP. Therefore, it makes little sense to make a contribution to get the immediate tax reduction, only to have to pay back that tax reduction in 3 to 5 years. Therefore, a TFSA makes a lot more sense in the shorter term, while in the longer term, an RRSP makes more sense because you want to defer the taxation of the withdrawal over many years. Question number 2, which tax bracket are you currently in? So are you in the 15% tax bracket as per your taxable income, or are you in a higher tax bracket, meaning 20.5% and above? Well, in this case, it's simple. The higher the tax bracket, in other words, the moment you are at the second tax bracket and above, the more sense it makes to contribute to your RRSP. There are 2 reasons for this. Number 1, of course, you're going to get a much bigger tax reduction if you are in the bigger tax bracket. For example, if you are in the 15% tax bracket, you will only get a 15% reduction on your taxes based on the contributions you make. While if you are in a 20.5% bracket and above, you will get a much higher tax reduction. Reason number 2, you will likely be in a lower tax bracket when you retire than when you were working. For example, when you start withdrawing from your RRSP account at retirement, you will likely be in a lower tax bracket than your working years. The reason for this is simple. You likely will have more expenses during your working years than you will have during your retirement years. For example, during your working years, you will have expenses related to a young family. Example, you might have a mortgage as well during your working years. These expenses should no longer be there when you retire, meaning that you will be able to live on less income at retirement than during your working years. So this is the icing on the cake when it comes to your RRSP accounts. When you make your contribution to your RRSP during your working years, you will get a bigger tax reduction because you are in a bigger tax bracket. And then when you retire and withdraw the funds, you will be paying less tax on the withdrawals because you will be at a lower tax bracket when you withdraw the funds. Question number 3, can you get free money for every dollar you contribute to either an RRSP or a TFSA? Now you might say to yourself, how does that happen? How can you get free money for contributing to one of these plans? It's simple. An employer-sponsored pension plan. There are employers that offer matching contributions to, for example, an RRSP account. So for every dollar you put into an RRSP account with your employer will match that contribution. So the matching contributions do not get added to your income. They will reduce, though, your RRSP room through what's called the pension adjustment. However, it is still a winning deal. Every dollar you put in, your employer matches. If you have such a plan, then it is an absolute no-brainer to put your money to your RRSP account with your employer instead of going with the TFSA. Question number 4. Are you a low-income earner and are you getting close to retirement? Now, if you're within, for example, 5 years to retiring, and if your projected income will be at around $19,000 or $20,000 or less, if you want to make contributions to one of these plans, your best bet would be a TFSA. The reason for this is due to the guaranteed income supplement that is offered with the old age security pension. So guaranteed income supplement is a tax-free supplement to your old age security. You don't get taxed on that income. However, in order to be eligible for that income, you must have gained less than $19,500 roughly. Now, should you contribute to your RRSP instead of your TFSA, remember that your RRSP withdrawals are taxable income, meaning that they could bump you out of eligibility for the guaranteed income supplement. A TFSA, in turn, is tax-free. Your withdrawal will be tax-free. Therefore, any withdrawal you make will not be added to your taxable income and therefore will not affect your eligibility for the guaranteed income supplement. So again, lower income earner within, let's say, 5 years to retirement, and you want to save in one of these accounts, it is a TFSA that wins hands down. Question number 5. Are you planning on purchasing your first home? Well, in this case, contributions to either account presents advantages. We know that future withdrawals from your TFSA account for the purposes of a down payment will be tax-free. With an RRSP account, ordinarily these withdrawals will be taxable unless you withdraw under the home buyer's plan. Now, to be eligible for the home buyer's plan, this has to be the purchase of a first home, meaning you or your spouse could not be an owner of a home within the last 4 years. Now remember that any withdrawal you make from your RRSP account under the home buyer's plan is essentially a loan. This is an amount that you have to repay back into your RRSP account. The way you do that is through installments. You repay by contributing back to your RRSP account through an installment. The government gives you 15 years to make that repayment, which means you take the amount that you withdrew divided by 15, and that becomes the yearly installment that you have to make back into your RRSP account. The government gives you a grace of 1 year, meaning that you don't have to repay your account for the first year, but you do have to start making the repayments as of the second year following the withdrawal. Should you fail to make the installment for a particular year back into your RRSP account, well then that installment becomes taxable income on your tax return. And now all of a sudden, your withdrawal for your down payment has become, for at least a portion, taxable income on your return. We hope you enjoyed this video. Please click on the like and subscribe button to get notification on the upcoming video that we will make. We're also looking for subjects. Please do not hesitate to write in the comments any subjects you would like to see within these videos. Thank you very much for watching.